Good morning, everybody, and happy Monday. Set the market here from the Steady Trader. We're going to get started in just a couple of minutes. Apologies for the delay. We had some technical issues, but we are here and ready to go now. So should be just a matter of another couple of minutes, and we can get started as usual. And hopefully you guys can hear me as well. That would be awesome. If you can. All right. Let's get started here. All right, good. Let's get started. I'm going to quickly create a chart because I crafted it over the weekend. And I just want to quickly share with you guys a little bit of where we are in the big picture. I actually don't think I have it here, so I have to quickly recreate it. Or actually, maybe it's here. Let me see. No. Yeah, no, I have to recreate it. Okay. All right. Again, good morning, everybody. Serge Berger here from the Steady Trader. This is our Set the Market morning show. We're going to spend the next 10 minutes or so going through the most important things on our radar. And what I'd like to start off with this morning is just a little bit of history as far as the S&P 500 is concerned. I'm going to quickly draw this in real time, and then what we're going to do, once we've done this, we're going to look at a potential turning point near term for markets, potentially by Wednesday of the Fed this week. I'll explain to you why that is. It has nothing to do with the Fed itself, but actually much more options related. And then I want to spend just a few minutes talking about the Max 7 complex and what the risks are there for a lot of people's portfolios. So I want to spend a little bit of time on all that here. But let's start off with the long-term S&P 500 chart. And so I'm just going to quickly try to recreate this so everyone can see this. But what I'm trying to share with you here as I'm creating this chart is that the S&P 500 can actually go into prolonged sideways periods. And I really, and I've only just begun talking about this to clients because I think a lot of people just haven't even been open to the idea of the possibility of this. But I think that's actually becoming our base case here pretty quickly, that we're going to end up going into a more of a prolonged sideways period in the S&P 500. And the problem, of course, is if you are a US-centric S&P 500 investor, that means that the portfolio might just literally go sideways for a prolonged period of time. And I think a lot of people are not prepared for that. It causes frustration. Ultimately, it causes a lot of people to essentially capitulate at the wrong time. So what I've almost completed my painting here, or my drawing. And what I'd like to share with you with this drawing is just a little bit of perspective, how long it takes markets to kind of go into a topping phase. And I don't know, like if this ends up being the topping phase just yet. I actually think we are in the topping phase, let me put it this way, but I don't know how long it takes to complete. But for example, if you just go back to the year 2000, it's the most recent one. We can go to other periods too, but that one is the most sort of recent major topping phase that we had just before the great financial crisis. The topping phase, which again I think we're in right now, is really a period of time that is going to it's really gonna take its time, right? So, and a lot of people are going to get very bullish on rallies, particularly the guys that they wheel out on CNBC every time the market's up 1%. It's always the same guys. They're the guys that have never seen a market they don't like. But let's just quickly go through this. So, for example, if you zoom in a bit closer on this and you look at the topping phase that took place from November 1999, to about November 2000. Year 2000, so about 12 months of a topping phase. It wasn't very different in what I remember very clearly to be the Great Financial Crisis, where we started topping somewhere in the spring to summer '07, and we didn't really complete that until, let's say, early '08. So there too, about a year of topping, and I'll explain to you why it typically takes that long to top in just a second. But I want people to be open-minded to it here. And right now, so far, we've been topping for, depending how, like tech stocks have been topping now for 3/4 of a year. The S&P 500, broadly speaking, has now been topping for like a quarter, not very long. So this can easily continue another 6+ months, right, of topping. So I wouldn't be surprised if we have a few pretty vicious oversold rallies and narratives come out of how Nvidia is going to be something we start, sprinkling into our breakfast in the morning, and complete disregard for positioning, which is really always the problem with that kind of narrative. You guys have heard me talk about that before. Good companies, and here's the thing. So why does it take so long for let's say the S&P to top? Again, it's typically been between 3/4 of a year to about a year. And that's because positioning. So if you imagine a big fund, right? It could be a sovereign fund. It could be, could even be just a very large mutual fund, those kind of things. For them to change their positioning, in this case, right now what's happening is they're scaling out of Mac 7 stocks. They've been doing it now for 6 to 9 months, at least. The people that I talk to probably more. But these funds are so big that it takes them a long time to do that. And so they're looking for basically rallies to sell into. So on a day like last Friday, they're now very happy to see if they can sell into this maybe today, or maybe if we get a bit of a further rally. I don't know exactly what they're thinking, right? But that period, that unloading of that amount of capital takes time. It doesn't take 5 seconds like you and I to quickly execute a trade. They need liquidity, a lot of it, and that really takes time. It can, and then they have investment committees, right? And everyone is allowed on the investment committee is kind of allowed to pee on the problem a little bit, and then that gets delayed, and then they don't make decisions for 3 months. So that's why it takes a long time. But once the topping process is complete, that's typically when we start seeing mean reversions. And again, I want to be clear, we're not looking for the end of the world. But I do think it's possible for the S&P to go down to 4,000. Not tomorrow, maybe not even this year, right? But that is an entire possibility. And I think very few people on the retail side, particularly self-directed U.S. investors, who is largely our audience here, are very, very ill-positioned for that. And even if that were to happen, even if someone wouldn't mind that, the problem is what probably won't happen at that point is this, right? So we're in a situation right now where the V-shaped reversal is back to all-time highs before you can, finish your beer. I think that era is over. And so I think we need to start getting our head around it, and, drawing a line on a screen and calling that analysis that's one part, but it takes a lot more than that. We need to understand flows of capital. We need to understand, what rates are doing and dollar flows, which we've talked about the dollar, right, for the past few weeks. I'm going to quickly just show you this one once again here. This is a very important trade-weighted dollar chart that I mentioned last week a few times. So when money comes out of Mac 7 stocks, because now there is the dollar on its own being pushed lower by the administration. That's what they want to some extent, right, to a degree. And because of a lot of other stuff, there's now a lot of other alternatives around the world to invest. And I guess I've been saying now for a few weeks, everyone that I know, in fact, I've been saying this probably for 3 quarters, is trying to look for excuses to buy other stuff other than Mag 7 to diversify. It's just a diversification question. So it goes back to positioning. So again, the dollar peaked almost exactly at the same time when the tech stocks peaked last summer, right? Again, for everyone that's feeding you bullish charts on NVIDIA, you may just want to quickly remind those people that NVIDIA has done absolutely nothing, zero zilch, since last May. Now, it does not mean it can't rally, but it probably is done hockey sticking to fresh all-time highs every 5 minutes, right? And that's a very different environment. And it has implications both for trading accounts, which I know a lot of people like to trade a little bit, but also more importantly for the larger pile of people's money, right? Because this is the S&P 500. So, and I've mentioned this many times, and I'm going to continue to mentioning it. Now, here is the thing with Mag 7 stocks, right? So if you look at MAGS, I'm just going to quickly bring up a ticker just to have something to show you on this. I actually think there is a lot of potential for these stocks to become value stocks. Which is actually a positive thing, right? These companies have steady cash flows. Some of them pay dividends even, some of them, right? And so there's actually a lot of reason to think that these guys are going to become value stocks. However, the gambling bubble we've been conditioned into because of all the huge budget deficits that the United States has been running, and everyone going into dollar assets because they're yielding more there. The exit doors are quite cramped, right? And so the question is, what is going to be the new leadership? We tend to think it's going to be, pretty much everything else, right? So I think we're going into a bull market of diversification. So, and that's where individual investors have a much more difficult time to operate on their own. So if you're listening right now and you had an easy time over the past 10 years because the S&P just bubbled higher every day, it is unlikely that it's going to be this easy going forward. In fact, a lot of people end up struggling a lot more in an environment where it's not linear because it's more difficult. And so maybe you've noticed that it's beginning a bit more difficult. Of course, in a trading account, if all one does is buy a couple of call options on something that's down, that's different. But I'm talking about your net worth, right? A lot of people that we talk to are focused on their net worth, not just on one little trading account that they're digging around with, right? It's about your overall money. It's silly to lose 30% in your net worth, but be up on a call option YOLO trade in your trading account, right? That doesn't make sense. And so I want people to kind of understand that. So that's a big point. So let's talk a little bit about this week to the here. And if you guys have questions on this, please let me know. But the right here and right now this week is important because we are going to be in a situation this week on Wednesday where we have the Fed meeting. And the Fed meeting is something, it's what we call a known unknown, meaning we know the date of something happening. We don't know the outcome. And so what investment professionals do is they tend to hedge for that time, for that day, basically, right? Typically, they don't hedge that day. That's an amateur thing to do. So buying a 0DT option for that day, that's a bit short-sighted because a lot of times news can leak. I think that's something people haven't fully comprehended either. But nevertheless, once we get past Wednesday, some of these hedges, in fact, a lot of these hedges, if not all of them, are going to come off, which basically means that natural buying pressure in the market might come back in. So I actually wouldn't be surprised if by Wednesday there's natural buying pressure that might give us some sort of a relief rally. Now, I'm not going to make a specific bet on that because there's still a lot of news and event risk, but psychologically, I want to be in a position that even if we were to see a sell-off on Wednesday, I know by later on Wednesday, probably Thursday, that those hedges are no longer on, and that natural buying pressure, coming into the market might have an easier time lifting the market. So it's more of a psychological exercise. So maybe then the S&P, can rally 3-4% off of, even levels where it's at as of right now here Monday morning. So that's kind of how I'm looking at things. hopefully this is helpful for you guys to kind of give you a little bit of perspective on sort of, you know, how the dynamics in this market are. But again, I think it's important to understand that we are going through a period here that is, it could be a 9 to 12 month topping process, and ultimately, you know, equities, as I showed you before, might ultimately then release to the downside. I'm going to quickly bring up this big picture chart again, so you guys can see this this big picture chart. And if you guys have any questions, as always, as I said, you know, please don't hesitate. But this big picture chart, I think, goes a very long way in kind of explaining, you know, how long the topping phases take. A lot of people get confused in the topping phases. A lot of narratives come up. A lot of stuff gets people kind of, you know, either sticking to what they've owned or they make rash decisions. But really, it's a timing factor at this point. So just want to keep that in mind as we start this week. It's going to be a busy one, as pretty much every week typically is. And again, keep in mind on Wednesday, maybe buying pressure will have a bit of an easier time sustaining in the market as hedges come off after the Fed meeting. So that's it for right now. Again, I do expect Mag 7 stocks to basically become sold again on bounces. So whether that's, you know, Nvidia or Microsoft, right? There's a lot of funds that are happy that are looking for liquidity in the market and for rallies to sell into, because they're looking to allocate elsewhere. Not because Microsoft's a bad company, but because the growth in some of those stocks is no longer what it was before, and also because now there's other alternatives, right? And so I know this takes a long time. I'm going to probably reiterate this every freaking day now for like 9 months, because I know it takes a lot of people a long time to A, hear this, and B, wanting to potentially accept it, right? Well, we'll see if it even works out. I certainly could be wrong, but everything that I see and everything that I talk to people about, it's very clear. And you guys can go back and check. I mean, we've done this podcast or this morning show now for it's probably been like 9 months. And I've been very clear that what we're seeing is pension funds de-risking out of Mag 7. And that's been a fact, right? We've talked about it since last summer. And you might notice that Microsoft and pretty much everything else topped in the summer. So that's been spot on, but it takes more time for people at home to feel that pain, because they still have a lot of hope that it's not going to affect them. There's nothing wrong with Microsoft as a company, but it might turn into a value stock and no longer a growth stock, right? And that in itself is a seismic shift in portfolio allocation in terms of what it means for people's portfolios, and it's just huge. Like, it's hard to overstate how important that is. But again, people typically have to hear that for, you know, a long period of time for it to resonate with them, and that's what I'm hoping to get across here today. So we'll see you guys back here tomorrow morning, Tuesday. If you are a member of Trade Ops, we will see you guys in there in just a couple minutes. Have a great start to the week, and we'll see you soon.